All right, I get a pretty substantial number of questions coming at me after I make callouts. In one of the questions is probably the most common. That is, why do I use the 75 and the 195-minute time frames? So I'm going to address that in this video, and I'm going to show you with math why I believe it's a better time frame to use instead of using like the 1 hour, 2 hour, or 4 hour time frames. And what we're going to do is we're going to compare two charts. We've got a Euro USD here on the top and on the bottom. And we have the 1 hour chart on the top and a 75-minute chart on the bottom. What we're going to do is that we're going to count the number of, we're going to analyze the two of these. So let's establish some rules. First, the theory was for me when I first was learning about the 75 and the 195-minute time frames. The theory for me was that when you are using indicators to help you trade, typically speaking, your indicators are going to be giving you readings based on the close of the candle. What happens is that if there's a really long wick, your indicator won't give you the data that's within that or relevant data that could be important regarding that wick. So you are only measuring, your indicators are only taking into account where the close is. Now, I get it, there are things that you can do to combat that and all that sort of thing, but I wanted to make sure that my indicators were giving me the most accurate representation, especially during trend trading. I wanted to make sure that I was getting the most accurate representation of the market movements as much as possible by minimizing the wicks, having fuller bodies on the candles. Now, I've gone ahead and changed the colors of my chart for this demonstration purposes, but normally speaking, I use different colors when I'm trading, and I've got a video about that. I encourage you to check that out. What we're going to do is we're going to, as you can see, the charts are synchronized. So I'm gonna go back to a time where there was a good trend. Here's a good trend right here. That's not bad. And so what we're going to do is we're going to count the number of candles between here and the low right there. So that's 178 bars. Okay, so we're going to go 178 bars here. And what we're going to do is that we're going to establish the rules in that same period of time. We can see that trend had a bunch of 75-minute candles as well. And from the high to the low, we have 149 bars. Oh, no, one over here. 149 bars. So what we're going to do is, I'm not going to go through the whole thing. Here are the rules behind our count here. What we're going to be doing is we're going to count how many wicks there are in this trend versus this trend. But of course, people would say, well, of course there will be less wicks on this trend because there are less bars. I get that. I totally get it. That's why we're going to be counting the ratio of bars that have wicks, or ratio of candles that have wicks. So how many of the 178 have wicks that are really long? And then how many of the 149 in the different time frames? Same trend, different time frame. How many wicks are we getting? Because again, it goes back to, we want to make sure that our indicators are as accurate as possible. So it's going to be the ratio between the two. Now, what constitutes a candle that has large wicks? It's anything where the body is less than 50% of the range. Okay, so if you have a high and a low, the size of the body of the candle is less than 50% of the extensions, okay, of the wicks. Less than 50% of the range between the high and the low. That's what we're going to do. So I'm going to give you an example of one where clearly we have where clearly we have less than 50% of a body. So here's one right here, right? So clearly the body is less than 50% of the range of that bar. So we're going to count them all the way through these trends, okay, or this one trend. Right there, we're going to make the box. So the box, these are the rules, guys. These are the rules of engagement. We're looking for this box. So I line up the crosshairs. I get another box over here. And we go across. And there's our low. Okay. So I'm not going to do all the counting on here, but I'm going to go ahead and count all of the bars in here. All of the bars that have bodies that are less than 50% of the range, and I'm going to do the same thing for this one. All right, so I finished up the count here, guys, and we have in that trend, we've got ourselves the 179 bars on this side, 149 bars on this side, because I was noticing that I wasn't quite lined up with the highs and the lows. So the highs and the lows are now completely counted. Now, okay, so 179 and 149 on the 1 hour chart. During that time, there were 83 candles with less than 83 candles that had wicks that constituted more than 50% of the range. And then we have on the bottom one, 149 to 46. That means that the potential indicator variance, meaning that your indicators may not be as accurate as you would like because of all the wicks. The variance on those on the indicator readings could be up to 46% on the 1 hour chart. Whereas on the 75-minute chart, we have less variance within the candles. Same trend, slightly longer time frame. The difference between the two, what is that? 30. That's 30 bar difference between the two of them. If it's 100, let's round it up to 180. So that's 1/6. Okay, so the 1/6 less number of bars. So if the wicks were consistent between the two, if we saw wicks all the time between the two, if the variance was the same, 46 and 46, then my indicators wouldn't be any more accurate going to a 75-minute chart. But because the variance is less during that trend, my indicators are going to give me about 16% better readings, okay? More accurate as to what the market movement actually is. Now, one question could be, well, why does this occur? Where do these wicks come from? I'll tell you right now. They come from the top of the hour. You see, what happens is when the top of the hour occurs, a lot of people are online. They're checking it out, right? Because they're getting, they're going to get their alerts or whatever else. And we notice it, anywhere between 10 minutes before the top of the hour to 10 minutes after, 15 minutes after even. There's a lot of movement that is indicative of a lot of manipulation. Us retail trailers, we simply don't have the liquidity to move the market. It's why there are called market movers. They move the market because they have the liquidity to do it. And what they're doing is that they're going ahead and taking positions towards the tops of the hours, because that's when most people are making their position, they're putting their positions in, okay? So if that's the case, we're trying to do our best to combat against the manipulation of these markets, then we need to figure out how to get our indicators to be more accurate as to the true movement of the markets, okay? Because these wicks, they create a lot of false impressions sometimes with the indicators. Now, this is more true for trend traders than it is for, say, a swing trader or even someone that does Fibonacci's. This is more for people that want to follow the trend, okay? Because those wicks can be communicating something else. But when we are trend traders, we rely a lot on indicators. And those indicators, we need to be as accurate as possible. You're not going to have 100% because obviously a lot of times these are going to be landing at the top of the hour, right? Like every 4 candles is going to be at the top of the hour. Okay, so there will be wicks. You're not going to get it 100% perfect. But what's nice is when it's just offset that little bit, we get less variance, less potential variance within our indicators, and we're able to make better choices in our entries and exits. So if you would like to learn more about trend trading, I encourage you to check out my website. Got the description in the link. I'm going to learn how to do little squares. I see them, I'm going to learn how to do that so that I can show you guys other videos that are related that may be helpful to you and complementary to the video that you're watching now. But I don't know if I'll be able to do that this time around or not, but I'll get the hang of it. But that's it, guys. That's my logic behind using the 75 and 195 minute charts. It just helps minimize those wicks and give me more accurate indicators. If you have any questions, let me know. Leave a comment. In the description, I've also got the link to book some time with me. And if you want to learn more about Lux, there's also a link there to go to the page and learn about Lux Algo, which has been very, very helpful in me being able to not necessarily find more opportunities. To be honest, I don't think I found more trade opportunities with Lux. And I know that may be disappointing, and someone from Lux might give me a call and be like, hey, don't say that. But the truth is, Lux helped me stay out of some trades that I would normally lose. So automatically, I'm making more money because of Lux. So again, thank you, everybody. Have a good day. Talk to you later.